You've got $600,000 sitting in a traditional IRA, and that feels like real progress. And it is. But here's what almost nobody runs the actual numbers on. Left alone, that account is going to hand you a tax bill you didn't plan for, every single year, starting at 73, whether you need the money or not. Households that do systematic Roth conversions before RMDs begin end up paying tens of thousands less in lifetime taxes compared to households that wait, according to Vanguard's retirement income research. The difference isn't luck, it's sequencing. And the year-by-year math on a $600,000 IRA, what it actually costs to convert bracket by bracket over 5 years, is what most people never see laid out clearly. So let's fix that right now. Before we get into the year-by-year numbers, I want to address something that was all over financial media in 2023 and 2024. The argument that you needed to convert as fast as possible before the TCJA rates expired at the end of 2025. That urgency was real then. It's not real now. The One Big Beautiful Bill Act was signed on July 4th, 2025, and it made the TCJA 7-bracket structure, 10, 12, 22, 24, 32, 35, and 37%, permanent. The 12% bracket is not reverting to 15%. The 22% is not going back to 25%. Anyone still telling you to convert fast before the sunset is working from an outdated playbook. That said, the case for converting a $600,000 traditional IRA before RMDs hit is actually stronger than the sunset argument ever was. It just rests on different math. So let me set up the scenario. Married couple, filing jointly. Let's call them Michael and Sandra. They're both 60. They've got $600,000 in a traditional IRA, and they have just retired or semi-retired with modest other income. They have until age 73 before the IRS requires them to start taking money out. That's under Secure 2.0, which moved the RMD start age to 73 for anyone born between 1951 and 1959. They've got about 13 years, but in practice, they want to use 5 of those years, ideally the 5 lowest income years right after retirement, to convert as much as possible while they're in a favorable bracket. Smart instinct. The question is what favorable actually means and how much it costs each year. Here's the 2026 bracket math that anchors the whole plan. For married filing jointly, the standard deduction is $32,200. That's the 2026 figure, confirmed by IRS Revenue Procedure 2025-32. The 12% bracket extends to $96,950 of taxable income in 2026. Add the standard deduction on top, and a couple can have roughly $129,150 of gross ordinary income before they cross into the 22% bracket. That's your 12% ceiling. Below it, every dollar of Roth conversion costs 12 cents in federal tax. Now, if Michael and Sandra already have, say, $40,000 in Social Security or pension income, maybe 85% of that is taxable, so call it $34,000. They've already used up $34,000 of that $129,150 ceiling. That leaves about $95,000 of headroom for a Roth conversion at the 12% rate before they hit 22%. And here's the problem with just fill the 12% bracket. If they convert $95,000 per year at 12%, converting $600,000 takes more than 6 years. 6 years is fine if you have time. But if they're 60 now and want this done before RMDs at 73, they have a comfortable runway. The urgency comes from wanting to finish before age 65 because of IRMAA, but I'll get to that in a minute. For now, the honest reality is, to convert $600,000 in 5 years, Michael and Sandra have to accept some conversion at the 22% rate. The question is whether that's a bad deal. My take is, it's not. The math is actually pretty clear on this. Let's walk through all 5 years. I'm going to give you real dollar amounts and real tax costs, not vague ranges. Year 1. They convert $150,000 total from the traditional IRA. After subtracting the $32,200 standard deduction and their $34,000 in taxable Social Security income, they've used $34,000 of ordinary income before the conversion starts. The first $95,150 of the conversion lands in the 12% bracket. That costs about $11,418 in federal tax. The remaining $54,850 converts at 22%, costing roughly $12,067 more. Total federal tax on the conversion, about $23,485. On a $150,000 conversion, that's an effective conversion tax rate of about 15.7%. Not cheap. But compare it to 24 or 32% when RMDs are forced on a larger balance at 73. And that comparison is what makes this rational. Year 2 looks similar. Another $150,000 converted. Same bracket structure applies, assuming income is roughly the same. Total tax cost is in the same range. Call it $23,000 to $24,000, depending on whether the IRA has grown slightly. At the end of year 2, they've converted $300,000 and paid roughly $47,000 in federal tax. The IRA still has roughly $300,000 to $320,000 left in it, depending on growth. By year 3, something changes. The IRA balance is smaller, which matters. But also, this is where IRMAA enters the picture. The year you turn 63, any income from that year will determine your Medicare premiums at age 65, because IRMAA uses a 2-year lookback. So if Michael and Sandra are both 60 when they start, they won't hit the IRMAA window until year 4 or 5 of the conversion, when they're 63 and 64. That's a critical sequencing note. In years 1 and 2, they can be more aggressive. In years 3 through 5, they need to watch the $218,000 MAGI ceiling. That's the 2026 IRMAA threshold for married filing jointly, confirmed by CMS. Crossing it by even $1 triggers the first IRMAA surcharge tier, adding roughly $80 to $100 per person per month to their Part B premium. That adds up fast. Year 3, they convert $130,000, still accepting some 22% marginal rate, but deliberately keeping total MAGI under $218,000. They're at about $185,000 to $190,000 for the year, well within the safe zone. Tax cost on the conversion alone, roughly $20,000 to $21,000. Year 4. Now they're 63. The 2-year IRMAA lookback is live. Their 2026 income will set their 2028 Medicare premium. I'd keep total MAGI under $218,000 here, which means the conversion might drop to $120,000 or less if Social Security has grown with COLA adjustments. The 2026 Social Security COLA was 2.8%, by the way, per the SSA, so their taxable SS income ticks up slightly. Tax cost on year 4's conversion, around $18,000 to $19,000. Year 5, they're 64. Same IRMAA constraint applies. This year's income sets the age 66 premium. They convert whatever is left. If the account has grown modestly at, say, 5% annually during the conversion period, the remaining balance might be $140,000 to $150,000. They convert it all. Tax cost, roughly $22,000 to $25,000, depending on the balance. Total 5-year federal tax cost, approximately $110,000 to $115,000 on a $600,000 conversion. That's roughly 18 to 19 cents per dollar converted. Now, and this is the number that matters, compare that to what RMDs would have cost if they'd done nothing. Under the Uniform Lifetime Table published in IRS Publication 590B, the divisor at age 73 is 26.5. On a $600,000 IRA that grew at 5% annually for 13 years, the balance at 73 would be roughly $1.12 million. The first-year RMD would be approximately $42,000 just from that one account on top of Social Security. That's fine when there are 2 of them and they're in the 22% bracket. But the divisor doesn't stay at 26.5. At age 80, it's 20.2, which means the RMD is nearly 5% of whatever the balance is. At 90, the divisor drops to 12.2. That's more than 8% per year, forced out as ordinary income. And that's where the real tax ambush is waiting. Here's the scenario that keeps me up at night when I think about clients in this situation. Sandra outlives Michael by 10 years. She's 83, filing single now, and the IRA still has $400,000 in it because they only partially converted. Her RMD that year is roughly $20,000. But her total income, RMD plus Social Security plus any interest, pushes her into the 22% bracket as a single filer. The 22% bracket for single filers in 2026 tops out at $48,475 of taxable income. After that, it jumps to 24%. For a widow with modest income, that's not a far-fetched scenario. And the single IRMAA threshold is $109,000 MAGA, half the married amount. Suddenly, the Medicare surcharges that were manageable as a couple are unavoidable as a single person. The math on partial conversion looks a lot less attractive from that angle. I work with people 50 and over who are planning their retirement, and honestly, the widowed survivor scenario is the one most couples skip over in this analysis. It's uncomfortable to model. But a $600,000 IRA that looks manageable for two people can become a genuine tax trap for one. Now, I mentioned a new wrinkle that not everyone knows about yet. The OBBBA also created a new $6,000 senior deduction for each qualifying individual who is 65 or older, available for tax years 2025 through 2028. This is on top of the standard deduction, available whether you itemize or not. It phases out at 6% for Medjai, above $150,000 for married filing jointly. For Michael and Sandra, this matters starting at age 65. If both of them are 65 or older during the conversion window, that's potentially $12,000 of additional deduction, which shifts the 12% bracket ceiling upward and effectively makes a modest slice of conversion cheaper. It's worth knowing, though the phase-out math requires a separate calculation for each household depending on where their Magi lands. One more thing I want to be direct about. Roth conversions cannot be undone. That's been the rule since 2018 under TCJA. Per IRS publication 590B, recharacterization of conversions is gone. You decide in December that converting $150,000 at 22% was a mistake. You cannot reverse it. So the sequencing discipline matters. Model before you convert, and pay the tax from non-IRA money if at all possible. Paying conversion tax from the IRA itself reduces the amount that reaches the Roth and effectively raises your true cost per dollar converted. If Michael and Sandra pay that $23,000 year one tax bill from a regular taxable brokerage account rather than from the IRA, the full $150,000 lands in the Roth and starts growing tax-free. One more rule that's misunderstood with Roth conversions. Each conversion triggers its own separate 5-year clock for penalty purposes on the converted principal, but that only matters if you're under 59 half-wolves. Michael and Sandra are 60, so this doesn't bite them. Once you're past 59 and half, the 10% early withdrawal penalty on converted principal is gone. The 5-year clock on earnings for a newly opened Roth account is a different rule, and that clock runs from January the 1st of the year the Roth was first funded. If this is their first Roth and they open it in 2026, their earnings are fully qualified for tax-free withdrawal starting January 1st, 2031. For a couple in their early 60s, that's well before they'd need the money anyway. So, what would I actually do if I were sitting across from Michael and Sandra? I'd convert aggressively in years 1 and 2, accepting 22% marginal rate on the top slice, because they're pre-IRMAA lookback and have maximum flexibility. I'd back off slightly in years 3 through 5 to stay under the $218,000 MAGA ceiling, converting at a rate that respects the Medicare premium cliff. I would pay the tax from their taxable brokerage, not the IRA. And I'd model the widow scenario explicitly. What does Sandra's tax picture look like at 83 with a $400,000 IRA versus zero IRA? The answer usually closes the case for a complete conversion. The one thing I'd push back on is the instinct to just fill the 12% bracket and no more. For a $600,000 IRA, that approach stretches the conversion well past 5 years and potentially bumps into the RMD window. Accepting 22% marginal rate on a portion of each year's conversion, knowing the alternative might be 32% forced income during peak RMD years, is not a mistake. It's a planned decision with clear math behind it. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this kind of year-by-year breakdown is useful to you, hit subscribe. This channel is built for people in exactly this situation, and there's a lot more of this kind of analysis coming. And leave me a comment with any specific Roth, RMD, or tax sequencing question you'd like me to dig into. I read the comments and I pull real questions into upcoming videos. Next week, I'm tackling something that comes up constantly. Whether a 25 to 30% savings rate to catch up is even realistic on a normal salary after 50, and what the actual math says when you run it honestly. That one might surprise you.